All right, good afternoon, and thank you everyone for showing up today's session. We've got about 1 minute till 4:15, so we'll just give it a couple more moments for people to gather. But while we're waiting, if you don't mind popping in the chat, just saying hi and telling us where you're from.
Jess, I'm getting your voice coming in and out.
I'm getting an echo very poorly.
All right, let's do this. Let's ask people in the Q&A. All right, first question. Can you hear Rick well? Yes. Okay, Jess, say something.
Is it me?
Can you hear Jess well? Jess, talk.
I'm talking. A strange echo. Oh no.
All right, well, it sounds like most people can hear us. Good.
That works.
Good. Okay.
All right. Well, I do apologize about the echo. I hope everyone can hear me okay. If not, and if something is terrible, just please type into the chat and we will do the best we can to make it through it. Better now. All right, perfect. So today we're going to talk about the trading mindset. So we have been having these sessions about once a month. We started with Tony, and Tony gave a great view just on the trading mindset and his process. And then a month later, if you attended that session, I went through the trading tips and trading mindset that we talked about some of the pioneers. We talked about the disruptors. I included Rick. And then we just talked about really being engaged. And so now we want to take that up to a completely another level and talk about the institutional trading mindset, because Rick is our Chief Market Strategist. He comes with many years of experience and he's traded a lot more markets, inclusive of bear markets. So we want to make sure that we cover that and dissect some of the feelings that are involved with that, but the trading mindset, the risk management, what we need to take into account. So really excited to have Rick joining us today to go through that process.
Well, thanks for having me, Jess.
Of course. And naturally, the compliance person in me, we have to start with a disclaimer. So types of securities forms and research tools that are in this video purely for demonstration purposes only, shouldn't be considered a recommendation by OptionsPlay or solicitation to offer to buy any securities. And this is not intended to be used for individual tax, legal, or investment advice. So now that that's covered,
another way of saying this is purely for educational purposes only. And even if Jess and I might say in a statement that, I'd be a buyer here, I'd be a seller there, that again is simply in a theoretical sense, not an official recommendation to take to the cleaners, and this is for educational purposes. So just make sure you understand it. Okay.
Absolutely. Beautifully said. So what I would love to talk through with mindset, and this is something that I've personally experienced as I've been trading these type of bear markets, is I, and probably like a lot of our clients, am extremely data driven. Oh, am I cutting in and out?
You are.
I'm so sorry if I'm breaking up. My internet, so terribly. I think I'm going to blame my husband. He's on a conference call upstairs, and I think it's the dual streaming, and I can't take him off. I apologize. But we'll try again. So my thought process when trading this type of market, I am extremely data driven and data heavy. And that's the way I make any type of decision. Is I feel that it's very important to do my homework and I'm gonna take my video off. That is a great idea.
Yeah, let's see if that helps.
All right, let's try that. Perfect.
That's better.
So when I am perfect. Okay. So what happens to me, and I've been doing my ideal trade in this type of environment is I love to sell bear call spreads when volatility spikes. And it is a shorter term trade. And that's something that I feel is a lot more aggressive. But what also happens with my disciplined approach or any type of trading is because I'm so data driven, but I'm also very cognizant of the macro headwinds. Sometimes I get a little uncertain when I'm following my technical analysis path, but I know something else is going to happen. So for example, I know that the jobs number tomorrow morning is going to really, really move the market, but we've also had other jobs data. So I feel like it's priced in. And there's this constant narrative of a Fed pivot, which doesn't seem likely. And there's just so many moving parts. So how do you manage all of those moving parts in a huge volatile environment? Did I come across okay?
Say it again.
No.
Say the last part.
So I'm so sorry, everyone. How do we manage thought process and trading processes when there are so many moving parts in the market? So for example, Fed speak and crazy volatility and things of that nature that can shift things very quickly.
So I think one of the things that you want to think about when markets do get more volatile and you want to be involved, but you realize that the moves can be excessive in either direction. And the one, of course, you care about most or should care about most right off the bat is how much something may go against you, is to cut down your typical trading size. So if you normally trade X amount of dollars and you're in a really high volatility environment, but you still want to play, which is often a great time to make money, cut down on how much you trade. So if you normally trade X amount, trade 2/3 X or half X. And this way, if you guess wrong and the market moves against you, and that move can be very painfully against you because of short-term volatility, you could still survive because you've cut down the size you're trading. If you had your regular size trade on, you could get stopped out very quickly. And then 20 minutes later or half a day later or a day or two later, this thing's right back your way. That's part of, playing and understanding high volatility environments. So what I generally do is when I want to still play in a time that could really make a significant move, I cut down how much size I trade. And that right away makes me more comfortable and willing to potentially sit with my idea at a greater amount of market movement against me. But because I have, let's say, half the size on, I can still live with it. So if normally I was trading S&P futures and let's say instead of using a percentage stop, I use a certain amount of points. And let's say I normally use 20 points as a stop. Now I can use 40 points because I've got half the size on, and I might need that extra bandwidth of volatility to that comes in the market and maybe send something 30 points against me right away, only to see it work a day from now. So I'd say when you're dealing with lots of crosswinds and it becomes harder to have the same level of confidence in what you're doing, cut your size down. It allows you to still play the game. Obviously, your gains may not be as much, but gains should always be secondary to what you could lose. And you don't want to get knocked out of something really quickly. Look, if you play tomorrow's 8:30 in the morning jobs numbers, right? So we have the employment numbers and non-farm payrolls. I suspect, and I was actually hoping that today was a decent update in the market, because then if tomorrow's numbers come in higher than expected, you could see the S&P futures fall 100 handles before we even open, given how much we've rallied recently. So I was really hoping today would be an update and a disappointing number for the bulls tomorrow. So today we end up selling 30, 40 points or so in the S&P. So you don't have as much a goosed up market as we had a day or two ago. But using tomorrow morning as an example, anyone who's got positions on needs to be following the market, not at 9:30 when it opens, but you need to be all logged in and ready to potentially act at 8:30, because if that number comes out and you quickly see a move, it's possible, especially if it's a disappointing number, that would suggest there's no way the Fed's going to stop. And we'll address that in a second, but there's no way the Fed's going to stop on their prescribed course of action. You could easily see the market sell off strongly. And even though the stock market's not open and you can't necessarily trade out of your option positions, you could potentially hedge. Spiders are trading at that point. Certainly futures are trading. So if you have any one of those ways to potentially or even hedge using stocks that are open, because the stock, there's all the trading that gets done pre-market. You don't want to necessarily wait until 9:30 tomorrow to do what you have to do, especially if it's going against you. If it's going your way, then maybe it's okay. But if it's going against you, you don't want to come in and start at 9:30 in the morning seeing the market down huge, if that's the way it is. Up huge is fine if you're long, bad if you're short, vice versa, if you've got the other way on. But understand that in volatile environments, be ready to trade, but find ways to trade that help hedge your positions if things start going wrong, because you can't afford to wait till 9:30 if the S&P is going to sell off 50, 100 or more handles off of this number. So if we get a big jobs number tomorrow, they're going to knock the heck out of the market, or at least I would expect them to. So,
well, it's definitely going to make a huge move. So I think that's great advice. So scale back your positions. So if you feel uncertain, so you really tackle the risk versus reward, which I think makes perfect sense. And then perhaps even broaden your horizons. So that's where, instead of just focusing on options, because we're reliant on data that is outside of normal trading hours for options, we could look at futures in addition to stocks that trade pre and post market to account for quicker action, because there's a market for quicker action, whereas you can't trade options at 8:30 in the morning.
And one of the things that I can recommend to anybody who is in the markets and is decently comfortable with the markets, so not a total newbie. There's a lot to learn if you're going to trade futures markets, and they're a different beast than trading stocks. But what you should know, just in case you don't, is that you can now trade a micro futures contract on the S&Ps that is 1/10 the size of the normal S&P contract. So instead of $50 per S&P point, it's only $5 if you trade the micro futures. So even people who don't necessarily have large accounts, now of course you need to get approval to trade futures in any brokerage firm you have, but do understand there is a way to hedge what you've got on, and all the way down to, so if it's $5 a point, the S&P is trading at, I don't know, 37.50. Let's just put that in round numbers. So it's 5 times 3,750. So for, I don't know, around $18,000 worth in that neighborhoods per contract you can hedge. So if you've got $50,000 worth of options on the long side that are bullish plays, and you feel like this thing's going to fall apart, if you sold 3 micro futures, you've just hedged roughly $50,000 worth of exposure. There are ways to do this, but I don't want you to go and open a futures account tomorrow and start trading them until you learn futures markets. So you need to read about them. You need to understand that you put a small margin amount relative to the value that you're trading, often only in the neighborhoods of 5% of the contract value. So if something moves 5% against you, you've just lost 100% of what's in your account. But when you're trading futures, you're trading a notional amount of money for a much smaller amount of down deposit. So there's a lot to learn in the basics of what futures trading is, but do understand that you can hedge yourself when the New York Stock Exchange is closed, if you understand futures markets. So just something, when you get volatility like this, and we know that between tomorrow's numbers and next week's Fed announcement, markets can really move quickly. There are ways to kind of get yourself hedged for those and anticipate or very quickly be able to act on what's doing and going on instead of trying to unwind 24 different option positions, which would obviously take you quite some time to do. You can grab the S&Ps or NASDAQ futures or whatever it is that you want, and very quickly in a very theoretically liquid market. There are times they get illiquid, but I'm just saying futures markets, you don't have to be afraid of futures markets, but you do need to understand what you're getting involved in if you do play with them.
Absolutely. And I think this same applies to options. So that makes perfect sense. Always understand before you trade, do your homework. Absolutely. And I do think tomorrow will be interesting. So I'd love to know your thought process on that as well, which I know it's just getting into your mind, Rick, if you will. Because
Sure.
I feel like there is demand destruction. So there was the job cut report today. Layoffs are higher. Jobless claims. Unemployment was higher. We see the retail, retail is even coming down, but the real estate market is collapsing. That's all demand destruction. But I know the imbalance in employment in the labor market is something that is just spoken about constantly. And so now this is where I'm unsure what the market would do. Seeing that those numbers come out today and the Fed consistently saying we'll be restrictive, we'll be restrictive, we'll be restrictive. So they are reiterating that thought process. And then those two numbers that I stated earlier coming out today, you'd think the market would rise on that because it's saying, oh, what the Fed is doing is working. This validates this so quote unquote pivot that people are thinking is going to happen that I do not think will happen. But I just find that odd. So does the market not like the bad news and is good news again? Or how do we shift from that as well before someone physically says it?
I haven't changed my overall tune that the market probably remains heavy, or maybe better said, is that even last week's low may not necessarily be the low for the move for good. Now, could we get a short-term, bounce that lasts a week or two, maybe a little bit more than that? Sure, you could. But here's the thing that I think, again, the public's getting wrong, as they did in June when they misunderstood the Fed statement. And right away I said, the investors have this wrong. Let them do all the buying they want. We'll figure out where to sell into. And, we did when we said 42.70 and north of there is all this market's going to go. Mm-hmm. The Fed chairman could not have made it more clear at his Jackson Hole statement that the Fed is going to do what they need to do to combat inflation and do it to the point of likely causing pain to the public and to corporations in their effort to control inflation, and that they will not stop until the job is done. Right? That's a direct quote from Powell. So all these people who think, the investors, I understand buying against the 200-week moving average in the S&P, which we hit last Friday right before the low, or right before the close of the day. We had a sequential 13 show up on the daily chart on Monday this week. So all the buying that's come in since, I get, but I get it more so as a near-term play with technicals from an oversold market that did make new lows, but has now quickly come back. So even if you sold on Friday, you already have some hints that that's not the right thing to do near term. However, if the Fed were to pivot, as people are saying, which is really people, they're saying it, but it's because they're hoping it. They're hoping it because they're long and losing money. If the Fed were to pivot now, after Powell made such a clear, an unequivocal statement of what the Fed is going to do for months on end, then they would lose all credibility in a month. And there was already talk of them losing credibility. And I think Powell came right to the table and said, this is what we're doing. You guys misinterpreted. It's wrong. And we are doing and raising rates until the job is done. So all these people who think the Fed are going to pivot as quick, a month and a half after he just couldn't be more clear what the Fed's going to do, are people who have a platform to get on the air, to get quoted, and to talk their book. But I can't see how any of that is going to alter the Fed chairman's thought process. So unless the jobs number tremendously comes off, and unless the upcoming CPI and PPI tremendously come down, he's going to keep doing what he said he's going to do. So I don't see the Fed taking their foot off the pedal. He just told us a month ago, we're going to put the foot on the pedal. And he knows eventually it's going to do what he wants to do, to slow the economy, to slow jobs. But I don't think we're talking weeks after he made that type of statement. Is the Fed going to now go, we don't really, maybe we'll just do a quarter point now. I don't think so. They're not here to appease us. They appeased us for far too long. And a lot of our personal wealth that has come, Jess, in the last several years came because the Fed basically gave it to us. But, the Lord taking, what is it? The Lord giveth.
Lord Powell.
The Lord giveth and the Lord taketh back. And this is part of the Fed taking back what they gave us. So it doesn't mean the economy's down the toilet. It's not. But to think that the Fed is going to pivot, I can buy this because of technicals. I can't buy it on the belief that the Fed's going to pivot. And look, I could end up being completely wrong, but there's no proof yet I'm wrong. And I don't think I'm going to be wrong, but I always know when I make any type public statement that there's a chance I'm wrong. Sure. I don't think the Fed's going to go pivot and give any inclination that they're close to being done after what Powell just said 6 weeks ago.
I completely agree with that. And I think he cares so much about his credibility. He loves Volcker so much. And I think he wants this is what he's going to go down in history for. And just like Volcker, he has a more restrictive policy. And I find that ever so interesting. And you are right. Immediately what came to mind was their dual mandate. They care about monetary policy and maximum employment, which I find as the most significant conundrum due to the imbalance of the unemployment space causing inflation. And that's what we need to see is higher unemployment. It's kind of competing with that dual mandate. So they're willing to put that aside for monetary policy. But what's not in there is caring about the stock market. And that's not in the mandate. And
no, and they can't.
I think that's important. Exactly.
They can't. And they've gifted us for years. And the COVID decline where they had to put in a ton more money into the system to save the global economy was overdone, was stayed too long. And now you got to pay the piper. And, so we're down 25% this year. And, it's not that different than what we were up last year. We were in the 20, the last couple of years, one year, I think, if you include dividends, was about 28%. Another year was 32%. So market's up in round number, 60% in the last 2 years. If they have to take some of that away, they're going to. And because the imbalance in the economy, too, of who owns stocks, and that the average person on the street does not have nearly the type exposure or their wealth involved as the well-to-do people, Powell has to look at the entire space and say, if the wealthy have to give back some of their wealth because stock prices go down, so be it. He's not here to keep bulls happy. That is not his job. It might be the president's jobs. It might be Congress's jobs. There are other people who try to keep things happy, but it is not the Fed chairman's job to make people happy. It is to do his and the committee's best ability, to their best ability, is to fight inflation and keep employment at the proper levels given how the economy is working. And that's it.
Yeah.
So the Fed going to pivot because Credit Suisse is having troubles? Well, A, they're not an American company, and B, I don't think Credit Suisse is going down. I mean, I don't mean the side, but I mean like going under. I don't think they're going to disappear.
You don't think
But
they're
if
Lehman?
they did, it's not the end of the world. It is to those who work there, and there's some spillover effect. But Credit Suisse going out is not going to take the global economy down. And there are other issues that are more important that the chairman of the Federal Reserve of the United States of America needs to worry about. So I think I'm clear in my thoughts here that the market could rally near term, but there's still big issues out here. Earnings numbers have not come down enough, and we're still likely, to start the month, I said we're likely going to see the mid 3400s in the month of October, and then Monday and Tuesday make me look stupid, but I'm looking at the big picture and I don't care about a couple days.
Yeah, that's great perspective. I think that's a good insight too, is looking at the big picture and not, that's a little nugget, not
Right.
looking at a couple days. I think that's great.
And put this in context, Jess, also of if you do think the market's in trouble for the next several months to 6 months to a year, and that we may very well face a recession, don't you want the market to rally so that you can again get some opportunities to lighten up on exposure?
Absolutely.
I welcome these. Thank God they come. Because otherwise you got to decide what to do with Apple at 145 instead of at 155 or 165.
Mm-hmm.
So it's good to have bounces if you still think the market's going down.
Absolutely. I think it's safe to turn my video back on. So what about competing policies? So I found that very interesting. And my thought process is perhaps they're just waiting until the midterms are over and then that will adjust, because controversial topic, and I know we stay away from this. I'm not saying it in that extent, but just trying from a market perspective, there's competition, I've noticed, from monetary and fiscal policy. So if monetary policy is extremely restrictive, but fiscal is adding more money supply and monetary is attempting to remove money, and this is not sexy, for lack of a better word, whereas this is, I'm wondering if that will shift once midterms are over, because it needs to. Otherwise, I think it leads to a bigger problem for the market, as in money supply. Video doesn't work.
Okay. Yeah. So repeat the last
No
10
video.
seconds of what you said.
Did you hear that
It was kind of
question?
very choppy. So you have the two competing sides.
Yes, and and thank you for using my hand motions there too. So as the midterms are over, I'm wondering if that will shift, because one seems welcome than the other.
Well, Powell is not supposed, the Fed is not supposed to be political. And I kind of feel like Chairman Powell is, as most Fed chairmen are, a strong enough person that he's not going to let the politics of the day change what their intent is. Now, could it alter it for a month? It could, but I think the answer to the fiscal versus monetary is going to come more down to election results, because if the Republicans take the House or the Senate or both, in theory, that's going to be bullish for stocks, or at least certainly won't be bearish. And that could give a lift to the market. I don't think Powell wants to make a major influence either way, but there are only a certain amount of Fed meetings left for the year to get done what they want to do. So to keep on track with what their target is for year end, I suspect that barring a very significant low number in tomorrow's jobs numbers, that next Wednesday, they're just going to do what they're kind of on course to do. And the monetary versus fiscal stuff will work itself out after we know what happens with elections and whether or not it'll be easy or not for Biden to get stuff done in the future. If Republicans make it tough for him to get anything done, then, it's like other presidencies where you often have the inability for a president to get their agenda done. And we'll see what happens. It's the polls are not reliable. And we just saw that in Brazil, certainly. Polls are not reliable. So we'll have to see what actually happens after the early November elections, and where the Republicans or how much they do or don't gain compared to where they are now. So it's a good question you have, but I think the answer ends up being that America will help determine that based on how they vote in early November.
Got it. That can certainly have a shift, which is what we're looking at, is purely just market direction based on results, opinion removed. Yes. Yeah. Which is important, absolutely. So there are a lot of questions in here about, we've definitely moved into macro views because the jobs numbers is tomorrow. So I think that's important to talk about. So I appreciate everyone letting us talk about that, because I think that's really top of mind. And I know we've got another session with Rec in the morning as well.
Right. So Jess, I know you need to go. So I appreciate you being on today and helping us walk through this. If you need to, I'll take over from here. I'll answer questions. And I thank you very much for hosting this and helping our OptionPlay clients. And as a reminder, I am back tomorrow morning with an open Q&A session. Normally I try to do it the first Wednesday of the month. I couldn't do it yesterday because it was Yom Kippur, and I'm Jewish, and I took the day off and fasted and did what we do on Yom Kippur. So we moved it to Friday. So send in questions now. The ones that are sent in early before we start the show live have a better chance of being answered than those that are put in during the show, because it shows that you took the time to do it beforehand. So send to customer service your questions. They'll forward them to me, and I'll go through as many of them as I can in 45 minutes to an hour tomorrow morning. So I'll get to your questions now. And Jess, thanks again for being here. Go to what I know you have another meeting.
Oh, no problem. And I will, one more thing to get to customer service. It is info@optionsplay.com. So you can send your messages there. That way Rick can give you some really great answers to that Q&A. But thank you for having me.
Thank you.
Enjoy, everyone. Talk soon.
Okay. All right, let me get to these. So Peter says, my question for Rick, you stated in the past that the cloud model is not a good technical indicator for shorter duration for those who day trade. Which technical indicators would or do you use for day trading? I have two accounts, one for day trading and the other is for long term. So for day trading, I still am going to use DeMark's sequential model. I can use that all the way down to a 1 minute time frame, but I'll look whether it's a 10-minute chart, a 20-minute chart, a half-hour chart, whatever. So I use that, and then I also like to use what is, depending upon how long you've been in the marketplace, you may know it as the volume profile, but most places now call it, volume at price. Let me see if I can share my screen and I'll show you, for instance. All right, so here's, for instance, the spiders, SPY. And what I've done here is had this show me the last 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days worth of volume at price, but you can do this intraday too. So there are a few books out on this, on how to understand how to read the volume in horizontal bars as compared to vertical bars underneath the price action. What you're seeing here is the total volume done in spiders at each price. Well, it's groups of prices because, you know, look, the more I spread this out, the more it can get very granular. But basically what it's saying is that, I don't know, maybe these are, let's see, 365, 363. So I don't know, maybe each quarter point or so is one of these bars, but you can see in accumulation how much volume was done at each price over the given time period. So in the case of this, I've asked for the last 10 days because that's where this gap down started from bar 13. So I'm kind of looking at, give me the total way of looking at where volume was done in this bottoming process. And we can see the heaviest volume for any one price bar was down here near about, I don't know, 362 and 3/4, something like that, right? It's got the most amount of volume. But if I look at this compilation in here, I have a bell-shaped curve, and then I have the beginnings of another bell-shaped curve. So when I look at this, I can look at where, if this is going to stay the low, then it's somewhere in the neighborhoods of where the highest volume was done that bulls would need to defend if they're going to defend the lows. So we kind of know between roughly 364 and 362 and a half or so is where the bulk of the, not the bulk of the volume, but the heaviest volume was done. And therefore, that to me is a level that if you are betting that the low is going to hold, if you get a chance to buy in there, then you buy in there against, and you stop it against the lows, because if the bulls are serious, they're going to defend this level. So that's a chart that I look at, but that's looking at 10 days worth. I could look at this and just say, give me the current day, And this is just going to show me today's price action. And I can't go into all the details on this now, but as you learn to, and there are some books on this. So let me think the names of the books. Mind Over Markets. I think it was written by a guy named, last name Dalton. The original guy who came up with this model, his name is Peter Stottlemyer. He wrote it, or he came up with it in the 1960s. He was a commodity grains trader on the Chicago Board of Trade. And so his books are, I don't remember the name of it, but I'm pretty sure his last name is spelled something like Steid, maybe EL or LEMYER or MEYUR, something like that, Stottlemyer, but not like the pitcher who used to be on the Yankees. It's ST, but there are no T's in the middle. It's a D. So he wrote the definitive book on this. And I'm sure you can find stuff online too in trying to understand it. But I used to teach this when I taught at NYU on a class on technical trading. This was one of the models I liked for real short-term trading because it can give you a sense of where real buying demand shows up. So that's another thing I look at. And again, here, I'm just going to switch this. This is spiders. I'm going to take a look. Here's a 5-minute chart. I just picked it randomly. And if you want me to pick something really random, I'll pick a 12-minute chart. Not something people look at, but I'll bet you DeMarc's model is still helpful in figuring out where to potentially be buyer or sellers. And if I look at this on a 1-minute chart, so here you have buy, pop, buy, no, 9, pop, 13 pop up to a 9 in the opposite direction. I mean, it's a very robust model, even down to the 1 minute level. So hopefully that answers your question, Peter. Long answer, but now this for everybody. If you're going to short-term trade, these are some of my favorite tools. How would you trade the pre-market on the futures if the market is trading down? Well, it depends, again, what your position is. If the market's trading down overnight and then you get a bad number and futures are really down big, then you start looking into the levels I was just showing you in spiders to see, where that support was. And I think I had said something like 365 down to 362 or something, 366 into 362, somewhere around there, I'd say is potentially where you'd expect to find support. So it could be down, but if it sells off a lot more, you might decide to buy them. If it shoots up, it's going to be harder to figure out if this is going to continue the up move or not. And so then we also need to look at the cloud chart and propulsion and other things to get a sense of what's actually going on here now. So since the low, we hit the 200-week moving average. Again, this is a daily chart. So on Tuesday this week, we had the big up day Monday. We gapped up big Tuesday. Here's the range in spiders. Wednesday, the real body was inside. And today, it's almost again an inside of an inside, which makes tomorrow a very likely decent move in one direction. So possibly some support near 368-ish. So we know that 368 to 366 to 360 is potential support. And then if we continue higher, this tells you that 384 and possibly even as high as 391 or 392 comes into play in the next week. So you also measure risk versus reward. So if you got down here, you, at least from a risk reward point of view, you're a better buyer than you are a seller, on the belief that bulls will attempt to defend where they should hold. And if it doesn't, it doesn't. But that's how you play this stuff. I'm surprised that OptionsPlay has a bullish position on spiders and a bearish position on Apple. There is no, so they're supposed to, I talked with the team earlier today. They inadvertently put that spider trade in. So I put that recommendation out earlier this week, but there is no official long play in spiders because we never sold down to the level to get into it. Plus, the bearish position in Apple was put on a week ago when the market was still going down. So it is, yeah, I could see what would sound like confusion, but they're put on at different times, and we adjust as we think need be. But do know that that spider position never got into. We needed to sell down. If you remember, it was either Mondays or Tuesdays recommendation, but we needed to sell down to a certain level in order to get into the trade. It was a conditional trade, and we never got it. So they are taking that spider trade out because it never got put in. What should I do with my stock positions? Boy, Paul, that is way too open-ended a question for me to answer. I don't know what they are, and it's just too big a open-ended question. How long would you keep the short futures position? Well, the same thing. Are you hedging positions that are long? So let's say you shorted futures and it worked out and futures fell, and you're making money in futures, but you're theoretically losing money on the long positions you have. Well, you need to kind of do them, unless you're good enough to buy the bottom and sell the high, you tend to take them off or unwind them at the same time because you've now hedged yourself such that you've protected your downside only as much as as many futures contracts as you're covered for, and you also limit the upside. So if you start losing in the futures, most likely you're making in your underlying positions. So once you realize that, once you hedge that amount that you've hedged, if you have a $100,000 account of value of long positions and you hedge 50,000 worth in futures, on that 50, on 50,000 of your 100, you're not going to make money on if the market goes up, because you're going to lose in the futures for what you would make on the underlying, and vice versa. Market goes down, you're losing, you had 100,000, but you've hedged 50,000 of it. So you can't, you're not going to lose, assuming that your portfolio tracks the S&P with some high correlation. By having the hedge on the 50,000 worth, you've at least cut the losses on half your position, so that if the market goes down, you're only now losing on the other half that you're not hedged on. So I can't tell you when you take it off. It depends upon what you've got, you know, why you put them on and what you've got against them. How would you calculate the ST? I'm not sure what the ST on limit is. So Kevin, maybe you can be more specific. Do you still think 42.19 as resistance, or you think it will pass the resistance? For now, I'm still in that camp that approximately, without a major change going on, 42.19. Now that doesn't mean you sell 42.19 if you get there. It means that's the place that you've now broken down from. It should be an area of resistance. That doesn't mean we don't go to 42.50. It means that in the general sense, if that's where I think we broke down from, then there should be some resistance there. So I'm still in the camp that that's the way to play the market until proven otherwise. What do we have here? 30, yeah, I know your numbers. Yeah, it's 30. It was actually 38.19. So Yogendra, 3 times you got it wrong, but that's okay. I get them wrong all the time. We move so much, it's hard to really remember which handles we're in. It's hard to, yeah, no problem. What's the S&P top to fade the long position in the short term? So here, let's just pull up the actual S&P chart and see if, I mean, they're going to be similar to the spiders, but okay, so we know kind of 38.19. So here I'd say 30. Let's just put this round numbers. 38.20 to 39.30 should be a significant level. Also notice where the lagging line would push back against the bottom of this cloud. So that's at 39.07. If we look at the weekly chart and look at where this would hit the bottom of its cloud, that's 38.69. So anywhere in that 3,800 handle is, in theory, some resistance from multiple different ways of looking at things. What are the 2 books you recommend for about charting and the DeMark stuff by Jason? So it's Jason Pearl, P-E-R-L. Jason's a friend of mine. He wrote a book on DeMark indicators that's much easier to understand than DeMark's books himself. I think it's called DeMark Indicators, and it's available on Amazon, and the author's name, Jason Pearl, P-E-R-L, and it's about $25 or so. Oh, and the 2 I recommend for cloud charting. I don't recommend 2 for cloud charting. I said there are a couple out there. I don't think any of them are great, but if I was going to pick one, I don't know, maybe I'd pick, probably David Linton, L-I-N-T-O-N is the author, and it's called Cloud Charts or Cloud Charting. Rick, at what point in the bear market do you think it's a good time to start doing leaps in quality large cap stocks that have hit year-to-date lows? So I assume you mean being bullish leaps in quality large cap stocks that have hit year-to-date lows. Well, you can always put, if you think that we're closer to a bottom, then you could start putting leaps on for, next year. I had a whole conversation with somebody today who I was coaching. You have to ask yourself, if you're buying leaps, are you better off buying leaps or buying the stock? Obviously, you don't lay out as much money buying the leaps, but not only does your direction have to be right, but your timing has to be right. And that's a pro and a con, and only you can figure out if you rather buy leaps or buy the stock. I've done both. I tend more to buy individual names because it takes the timing component out. We know that we've just sold down to the 200-week moving average. Certainly, it could be a significant low. I mean, the last time we hit the 200-week was on the COVID sell-off. We went beneath it by 17% and then came storming back, and we had a massive bull market. It's not a crazy place to think of buying leaps or stock, but the question is, if you buy leaps into, let's say you went out 9 months, and it takes another 3-4 months to even figure out if we have a bottom. You've now just lost 4 months worth of time premium. That if you bought the stock, if we're still in the same general area 4 months from now, you haven't lost anything. It's, leaps are any long-term dated option is a question you have to really figure out is how badly you want to own the name. Do you have the money to buy the underlying or not? What you're, willing to risk on it. And do you want to have both the difficulty of picking direction and the timing of it as compared to just the direction? Either way, I think you need to use stops. And I feel like a lot of people, when they put on leaps, don't use stops because they say, oh, I still have 4 months to go for something to happen. But as I explained to my coaching student today, if you've bought leaps already this year and you're losing money on them and you haven't used a stop, then go look at pull them up now and look at what they're priced at and what their deltas are. So if you've got really low deltas, then the likelihood that your leaps are going to come back by your expiration date are very low. Now, if it's a really low delta, at this point, you've probably lost enough that it may not pay to sell out of it because you've lost 80% or more. But if you've got stuff on that have deltas of 30, 40, or 50's at the money, but I'm just trying to think if there's a point where leap buyers, I think, fail themselves by not stopping out and taking a loss because they go, oh, I still have more time. But if the likelihood is greatly reduced that option's ever going to come back for you to be able to make money on it, then use rallies to sell out and lighten up and just accept the loss. And maybe the loss won't be as bad as it is now, but I have some names that I'm under on, but I'm willing to hold because in general, I feel like I got them in a decent enough place that I don't have to have the exact bottom for it. But in 5 years from now or 10 years from now, I feel like I'll be fine. And generally, in stocks you are, unless you go through one of those periods of time that you just get like a lost decade, like we had basically from 2000 to 2012. 12 years, the market was flat. Do you or your firm make any Series A type investments in new companies, medical technology field? No, not that I'm aware of at all. That's not what we do here at OptionsPlay. Would you DCA into stock positions you prefer versus leaps? So would you DCA, is DCA meaning average in? I'm not sure, Steve, if that's what you're asking. Would you DCA into stock positions you prefer versus leaps? I'll try to get to, rewrite that question so I'm sure what it is that you're asking. Are there leap puts as well as calls so we can do cash secure puts? Are there leap puts as well as calls? Right. So Bill, yeah, I mean, we've done some, it's rare, but Tony has done some leap puts. I think he has sold some leap puts. What are your thoughts about selling 1 year out of the money puts on spiders or Qs? Is a leap cash covered put a thing? Yeah, I think you can do cash covered leaps. You'll have to check your brokerage firm, but if it's cash covered, they should let you be able to do it. And what do I think about going out a year? Pick a place, a level in the S&P that you're willing to buy regardless of what the news headlines are. I mean, that's what you have to do. If you're going to sell a put, you're basically saying, and you're going out in time to do it in leap type fashion, you're basically saying, if the market gets here, I'm a willing buyer. So if the low 3000s are a place that you're willing to buy and you sell a put now, and even if that put gains much more value, if we got down there, you have it, it's cash secured and you're going to buy the stock, then you could do it. Sure. Just, know what you're getting into, but yes, you could do that, but you're making a definitive decision that you are buying there come hell or high water. What was the email that you can send questions for tomorrow? info@optionsplay.com. Steve says yes, so let me go back. Okay, so are you saying, would you average into stock positions or do you prefer leaps? If a stock is sold off, if you've gotten a stock that is really sold off significantly and you feel like it's getting closer to a bottom, then I would scale into it and just, determine your scale levels and that you're going to hold this for quite some time because you still could easily face downside pressure. But yeah, I don't think that's a bad idea. I don't like buying a stock at 50 and then at 30 saying, oh, let's buy more. No, your purchase at 50 was bad. I don't average down on losers. I don't mind averaging down when it's part of my game plan to average down, but not because I'm getting killed on a stock, so I might as well buy more. I don't do that. What was it? The SPY daily play didn't say it was conditional. Sure it did, because I said, if the SPYs sell down to this level, then we'll put the trade on. Should you close it? So, well, you're probably up a little money on it if you put it on. Actually, I don't know, because if you put it on, we didn't get into it. So then let's see, you sold the put. We had... did you put it on Tuesday, the same day? If you did, then let's see, Wednesday was not much. Thursday is a down day. Well, at this point, I say, here's a perfect example of Erasmo probably paying close attention to what happens tomorrow after 8:30, between 8:30 and 8:45, and potentially hedging, spiders. You might not be able to get, you won't be able to play the spider options at that time, but or I don't think they're open before the bell, the 9:30 bell. Maybe they are, I'm not sure, but you certainly could hedge your position with spiders themselves. So most brokerage firms do let you trade before the open. You just have to, it has to be designated as a pre-open trade. Was the TLT put touched on? Well, it was, it was touched on in the sense that we got into a position on Friday. We said to buy it if TLT fell to 102.5 to 101.5. So we got down to 102 something down there on Friday. So at least you could have put something on. We recommended taking a third of it off today. And it's probably right back to the neighborhoods of where we put it back on going into tomorrow. So that's okay. We've lightened exposure and it's still potentially playing for rates to go down. We're still in that kind of 370 to 383 range that I've talked about as being a level I think we can hang out in. Give the name of the author for the technical analysis. Danny or Ganny, which technical analysis are we talking about? Jason Pearl's book on DeMark indicators. It's Jason Pearl, P-E-R-L. If it's the cloud chart, it's David Linton, L-I-N-T-O-N. Those are the two books I spoke about today. When would you buy weekly options instead of monthly options? I buy weeklies basis. It depends where they're reporting earnings. When a Fed announcement might come out. Also, weekly options often have more individual like stock levels, so you don't have to jump from a 50 to a 55. A lot of times the weeklies have a 50, a 52 and a half, and a 55, or they may even have a 50, a 51, a 52, a 53, 54, and 55. So I use them depending upon a bunch of factors, but usually it's how long I think the likelihood of a particular move is going to happen or when it's likely to fade, as well as what's going on in the market. What's the chance of us having another lost decade in the current environment? I don't know if we'd have two lost decades that close to each other. It's never happened. In my knowledge, like offhand, I don't think of it as ever happening, but nah, I don't think we have a lost decade, but I'm still in the camp that this could get worse than we've already seen. Dollar cost average. Yeah, I knew that's what you were thinking of, Steve. So I've answered that. In the next 4 to 6 months, do you think gold will go down? It's all going to be based on the dollar and interest rates. We did drop below that support level, and I've written recently that it should have cracked and cracked quickly. It did not, and therefore I'm not bearish gold. Because when something should happen and it doesn't, and that, when you break a level that's 6 times held and it doesn't crack, then it's telling you that it's probably not going to crack. So unless the dollar screams to new highs and holds those highs, gold, you're towards the lower end of the range. I'd look at gold between probably 1690 and 1700 on the long side and stop out on new lows, because there you're risking only, I don't know, 30, 40 bucks, 40 or $50. And you're, and if it is the bottom of the range, then over time, gold's going to make its way back up. So right now, the fact that gold didn't crack, I'm not bearish gold. How to play stop limits. There are several options on the Street Smarts Edge. How to play stop. So it takes finesse to know how to place stops that don't get taken out. So you try to take non-obvious places. It's really a whole art that I can't teach quickly. I've addressed it before in some other seminars I've done and webinars. In fact, if you go to YouTube and you put my name in Rick Bensignor and in the No Trader, there are approximately 160 videos that I've done over the years. And I just recently started my own YouTube channel, which is In the No Trader. I used to do them for stockcharts.com. I don't any longer. I do them myself. But between the universe, the library universe between the two, you will find, in fact, it's in the ones that I did for stock charts, but still findable under Rick Bensignor In the No Trader, that there is a whole thing I did on stops once, and that's probably the best way that I can quickly tell you how to learn some stuff about finding and how to play stops. All right, we're actually over an hour now. Let me get to, so I've been going Q&A. Let me just look on the chat side. Institutions decide where to cut losses. Institution, how do they decide how to cut losses? It's often by committee, and I mean, it depends. If it's a hedge fund, it's just going to be generally the fund manager himself who will make the decision. If it's a mutual fund, it's often by committee, even if the committee is part of a particular portfolio managers group, but they usually get input from several people depending upon what the current fundamental outlook is, to some degree what the charts might say, but they're generally not well versed in that. How much they're losing, what's the likelihood they may buy more, so they may average, cost average. It's not a simple thing of that it's just, one person instantly goes, okay, let's get out of something. What would be a disappointing number? Probably tomorrow, I would guess, if it was above maybe 300,000 for non-farm payrolls. Here, actually, let's go take a look. I think I have up, here we go. Let's see. So Friday, non-farm payrolls. So the consensus 250, Trading Economics is forecasting 290. Last time was 315. So Street's looking for 250. These guys are saying 290. I don't know. I would say 300. It's going to be a disappointment if it comes in between 250 and 300. I'm not sure. It may be just like not affect the market a heck of a lot. So you got to look at, what the unemployment rate is, non-farm payrolls, and then also these days people are looking at the participation rate. And look, there's some other numbers out tomorrow too. Wholesale inventories come out at 10 o'clock. So that's my guess. 300 above is not going to be taken well by the marketplace. I think, guys, there's at least 30 more questions in the chat, and Q&A still has a few I haven't gotten to. My voice is going. I still have a report to write, 2 reports to write, actually. So we're going to call it quits here. I thank you all for listening and staying a part of this. And again, I'm back tomorrow morning with the open Q&A. So if I didn't get to your question, I'm sorry, send it in to the team at info@optionsplay.com. See you mañana.